Hello and welcome to Moneycontrol. Well, US President Donald Trump has done the unthinkable and something that is unpalatable for most countries. But guess what? It's the American markets that are bearing the brunt of this carnage. As it seems now, this might be a pivotal moment for India. We stand tall in a relative world where all economies are likely to face some degree of disruption. It's quite possible that foreign investors may begin to recognize that the case for American equities is weakening as President Trump shifts focus from Wall Street to Main Street. That could push global capital to look elsewhere, and India could emerge as a strong contender thanks to the structural growth story. Alternatively, larger funds may rotate into some other developed markets, Japan, Europe, simply stick to debt in the US, which offer a fairly safe return with less risk. So how do you really look at this big picture? How does a global investor think in this environment? And for us Indian investors, how do we stay focused on winning opportunities in Indian markets? I'm Mahalakshmi, and I have with me somebody who's an experienced hand with a lot of experience dealing with foreign investors, Prashant Khemka, founder of WhiteOak. Thank you so much, Prashant. Such a pleasure to have you in the studio today.
My pleasure.
So first things first, how do you really look at this Trump reset? Is this really a big reset in terms of how global investors really think about US? Because that is the pool of capital, 60% of global money rests there. How does that money or how do those investors really think about this reset? There are voices, and last few days, of course, we've been speaking to a lot of people, and the sense that I get is this is perhaps American markets topping out. And from anything that we have seen in the last 25 years, definitely American markets have behaved like emerging markets in the last few days, last night actually.
Government has behaved like an emerging market government as well.
True that.
So I think it is the biggest event since COVID, which is about 5 years ago. And the volatility in the markets are highest, at their highest since the COVID time period. Because right now the uncertainty is extremely high. It would take some time to know what really plays out. I don't think these are the final tariffs. I think a lot of it would be negotiated over the coming months. He's gotten himself into a strong negotiating position with a lot of his allies and other trading partners. So as this plays out over the next few months, we'll later only know what the final impact, how that would, or have a better arms around what the impact could be. But as things stand today, if we take what has been announced, obviously the market reaction across different asset classes, if you see, with commodities have fallen, bond yields have gone down, so the bonds have rallied, you have equity markets that have fallen. If you look at all this, what the markets are saying is growth, GDP growth around the world is likely to be lower going forward, at least in the near to medium term. Inflation is likely to be lower as well. Now the impact isn't going to be the same everywhere, all around. Now GDP growth, there'll be direct first order impact and second order impacts and whatnot. India, as you pointed out, might be relatively less disrupted. I think if you look at the tariff table and if you factor in the reality that India has one of the highest tariffs compared to anywhere else in the world, the tariff on India is relatively lower. So it is not an event which equally affects every country. Certain countries are going to be more affected. Net, I think India would be a relative better performer from an economic perspective. China and Eurozone, China most particularly and Eurozone might be more negatively affected. So it depends on which sectors you are dominant in your export basket. So if it is very capital intensive, and again at a massive risk of generalization, but more capital intensive, less labor component would have greater risk of, because capital is very fungible. You can move capital any day to the US. Obviously it takes time to build factories and whatnot, but to hire, let's say, garmenting as an example, to hire tens of thousands of workers in America is not likely to happen for garmenting.
Right.
So garmenting, the taxes would be there on all garment exporters, and then the relative taxation would determine who's benefiting. So if, let's say, Vietnam, China, Cambodia, these are typical competitors. So India is amongst the lowest tariff amongst these countries. So it is possible that in this particular niche, as an example, the competitive position of Indian exporters might improve. Because garmenting isn't likely to, maybe some of it, some portion, tiny portion might move back to US at the very high end, but the vast majority, I don't know, maybe 80-90% or more, would still remain imported.
Right.
So those puts and takes would be there. As you pointed earlier, I would agree that India would be relatively less disrupted on the whole.
Right. And what do you think of? And what do you think of capital flows? Because that's the real question that we've been debating for a long time. And it was always clear that, medium term, long term, dollar might weaken. The case because of the deficit, the large surplus. Now, at least in terms of intent, Trump has, with this sort of a announcement, proved that he really intends to do something serious, right? And there are also these younger Trump videos, which, from 25 years back, which sort of, he's been very consistent. So if this comes to pass, indeed, if he is, prioritizing Main Street over Wall Street, how do you think capital flows will realign? And I'm not asking for how it's going to happen, probably 1 or 2 months, maybe nothing may happen. So what do you see as an immediate result, and what do you see as a 1 to 3 year result, realignment?
Capital market or the capital flows are a function of the market movements. If the markets are down, they would tend to pause or move away.
Right.
If the markets rally, they would be sucked in to that market. So over the prior 12 months, let's say till January, US markets were doing very well. So the money from around the world, asset classes, across asset classes, were moving back to the US or moving into the US. Now, last couple of months, we'd already seen as US dropped about 8 to 10% negative, NASDAQ in particular, that questions were being raised by investors and asset allocators globally, and we'd already seen a slowdown for US and a normalization for flows in EM and for India as well. We've all seen that it's not unidirectionally big negative numbers for FII flows. Certain days they are less negative, certain days is a positive as well. So my assessment would be that the flows for India and EM should be positive, as US has underperformed emerging markets year to date by double digits. And in that case, and if it remains so, if now all this is with the caveat, if US markets for whatever reason were to bounce back more so than emerging markets, then that would not happen. And why I talk more about emerging markets, because bulk of the flows in India are a function of what happens to emerging markets, because still India dedicated flows are a minority. 20-30% of all flows we get in India are a function of India dedicated flows. Vast majority is still what happens to emerging markets.
So you're saying this is time to pause.
See, the investors, asset allocators, they are pausing, or they are incremental dollar not sending to the US and are allocating to Europe, Asia, Japan, emerging markets, Japan, and so on and so forth. Yes.
So now, till day before yesterday, I think after the announcement, people were still predicting, and I think Wall Street Journal also has had a piece that, there will be huge redemptions from emerging markets now, because, for most of the economies, it spells bad news. For us, relatively, we are insulated. But for most economies, it does spell bad news. I mean, they will all come to negotiating terms, and probably some sweeteners might happen. But for most of them, because they are export-oriented economies, whether you look at Taiwan or South Korea or, of course, Vietnam is a very serious case. So most of these countries, fundamentally, they are going to see some level of disruption. So is it a given that investors will be dissuaded from from investing in emerging markets. That's number one. Second thing is, for a long time, at least in the go-go years, last one year, we have seen quite some correction. But people used to say that, India will be looked at as an asset class. India dedicated funds, asset allocators will allocate more funds to India dedicated funds. Is this that moment when this sort of, pivot can happen, or is that wishful thinking?
Think of first question, the EM. At least so far, we aren't hearing that from our investors.
Yeah.
If there is a continued downward drift in global equities, and investors then pull back or reduce their allocation to equities and move more towards bonds, then it could be that across board, the allocation to equities are reduced.
Goes down, right.
As of now, we are not seeing or hearing that kind of a concern from investors. And EM has outperformed US so far. So if at all, it could well be that overall equity allocation, to the extent it goes down, might come more from the US than from EM. As I said, firm believer that the investor reaction is a function of market movements. So that is on the first one. India as a standalone asset class, I think again would be function of market. Our market, we had become the largest till 6 months ago, let's say around October or till October. India in some indices had become larger than China.
Yeah.
If you look at MSCI IMI, which is an all cap index, China had come down to about 22-23%, and India also was 22-23, just a smidgen ahead of China. So as a country becomes very large proportion of a global index, at that time such discussions in investor boardrooms or institutional boardrooms, they do begin that shouldn't we allocate as a separate asset class, like Japan has been for a long time.
Correct.
And so on. Obviously US has always been one. But over the last 6 months, that chatter has actually gone down. As Indian market, as Chinese market did very well. So China became now back to 30% or thereabouts of global indices. And India underperformed. So India is now 18% of global indices. Taiwan is in fact slightly higher than India. So right now we are not hearing as much. Again, the requests for EMX China funds have also gone down. Now China is well liked again, and India as a standalone, it is continues to be. Many institutions do allocate India dedicated mandates, but it's not spiked up. If anything, last 6 months that has taken a back seat.
Okay. Now you were saying that there could be some. In some specific sectors, there could be relative opportunities for us. So what are those sectors where you mentioned apparels and textiles, of course. Are there any other pockets where you see export opportunity can really be big? One thing, so you can first answer that question, and then one specific question on defense, because this is also the most, I think, debated sector, because opinion is sharply divided. 1/4 of investors I speak to say that, this is a very long-term opportunity. Not only is India investing in the defense story, it's also possible that a lot of peripheral goods, because Europe, Germany particularly, not invested in defense for a long time. It's a global theme. Everybody is investing in more and even if we don't do high tech, we will get a lot of peripheral stuff that we will get to do. How do you see this as an opportunity? But that's the second question. First, the broad brush. Where are the big export opportunities, if at all?
Very many, Mahalakshmi, as a consequence of these new tariffs. IT services is already there. Nobody is competing really with us, and the tariffs don't have much of a direct first order impact. It is more to do with if there is a growth slowdown in the US, then the demand for IT services would be lower. So yesterday, all the banking stocks in the US were down close to double digits. If they are reflecting the fear that there will be a slowdown in corporate earnings and slowdown in banking earnings in the US, which represents about 40% of Indian IT services business, so they are going to then constrain the IT spending. So that would be the second order effect on India, but not that India would lose market share to others. Now, in case of other big pockets, if you see engineering goods, let's say is a very big bucket for India. There it would be a mixed effect relative to, say, China. We would be a share gainer, but net there the risk of more manufacturing in due course moving to the US is higher. Because again, it's more of a capital intensive with few jobs, right? So let me give you an example at an extreme, which doesn't, not necessarily that India is involved there, but highly automated automobile plant is more likely to move back to US onshore. Yeah. Now India doesn't compete in that area, but those countries that do, they would have greater loss as imports into US are substituted by locally produced cars. It may be the same, Toyota is shifting its manufacturing from wherever it is to US, but that would be a greater hit. As against that, as the other example I was giving on the other extreme, garmenting, where it is very low end, tens of thousands of jobs. I don't know how many employees are there in a highly automated car plant, but there are far fewer jobs, and those skill sets are, and to the numbers that they're required, they're readily available, or not readily, but can be found in the US as against a garmenting plant. So that would be the kind of industries that India would benefit at the expense of, meaning garmenting or engineering goods at lower end, where manual labor involved, low skilled labor involved, and labor is a much higher component of the bill of materials. Where it would be difficult to make it onshore in the US anytime soon, unless those things can be automated, but I'm leaving aside that possibility. If highly manual or high labor component, where India was at a disadvantage to, say, some of these other countries, those segments India would become more competitive. Just like when tariffs are, Indian government is announcing tariffs or non-tariff barriers on some of the imports from, including China, because anti-dumping or other such measures because of the unfair trade practices, if you will, then that manufacturing moves to India to some degree or the other, right? Similarly, in this case, it would move out of China and to other countries, and India would be a beneficiary on that front.
Fair enough. Now the defense question.
Yes, very logical, and I would expect that to happen, because what Trump has made clear to Europe is, you are on your own. We are no longer the big brother who will have a protective arm around you. So other countries also would get the message, not just Eurozone, but be it Japan, be it other countries that have benefited from a explicit or implicit security cover from the US, they're likely to step up their own defense spending. So as not to be reliant on US, because while Trump is for 4 years, but who knows, now other presidents who come in future may have similar line of argument. So if defense spending does go up substantially, Indian defense companies would have a role to play. And as you said, these might not be the high-tech aircraft bombers, but there could be arms and ammunition where India is very capable at producing very competitively.
I'll come to the stocks part. So how do you, we talked about flows earlier, right? So where do you see FII selling stopping? I'm sorry, I'm asking this question again, although you said that, flows essentially chase performance. So we'll have to still wait and watch. But there is always this conversation that, ab kitna bechenge? Itna bech liya. From 32% at the peak, FII stake is now already down to 17%. What is your take?
Dedicated selling that we saw in October-November time frame. Since then, we haven't seen India-specific selling in our business at least, and I think that's true for the market as well. What we had seen in January-February time frame, or say December post-Trump election, was more a flow outside of EM and going towards US. That I do believe should slow down considerably, if not reverse. Again, subject to market movements, how emerging market does, that could even reverse. So right now it's very difficult to say, and it would definitely be a function of how the markets do.
Sure. So why I was asking this question is, in terms of relative opportunities, most fund managers agree that there is more value in large caps, and it is only because of FII selling that there has been a cap on their performance, in a sense. Of course, in recent times they've done slightly better. What is your take, and how do you bring this flows into your valuation equation, if at all you do?
Don't pay much attention to the flows really. We haven't figured out a way. We don't believe there is a way to really benefit from that information. Look, since COVID 5 years ago, small caps had a phenomenal rally. They're up, even today if you look at trailing 5 years, they're up 5x. So the pendulum had swung a little too far in certain pockets of small caps to one extreme. A lot of that froth has been taken out over the last 5-6 months. Small caps are still, compared to historical ranges, at a premium to large caps right now. At about, say, compared to the longer term average, they're about 20% premium to large cap. At peak, they were 36 odd percent premium as per the numbers that we see.
Right.
So a lot of that froth has been taken out. Doesn't mean it cannot continue to go down further, but I think now they are more in a reasonable zone. We structurally remain, I haven't found anybody make money by switching from large cap to small cap to mid cap to large cap this way. We have structurally, like for the last 18 years that I've been managing India portfolio, I've been structurally always overweight small caps. And not because I believe small caps would outperform. It's just the opportunities to generate outsized return or outsized alpha is higher in inefficient pockets of the market, which is what small caps provide. Now, from a risk management perspective, you contain the degree of, you don't let 100% of the portfolio be small cap. It's not like your personal portfolio. So it would be fair to say last several months, the allocation to small cap stocks in our portfolios has been towards the low end of its historical range, even if overweight in small caps. So we still don't find, table pounding opportunities across board in small caps. There are the pockets which were overvalued, where valuations had gone to extreme. They still are, fairly punchy. They've lost a lot of that exuberance, but they're still fairly elevated. Froth has been removed, but they haven't normalized, I believe. At the same time, there are pockets. So let's take some examples of some sectors. So consumption sector. We haven't seen any euphoria in consumption sector, be it large caps or mid caps or small caps. This small cap rally over the last 5 years has been predominantly in cyclicals, deep cyclicals. And thematics. So manufacturing, energy or power sector, defense, and a lot of this could be for good reason, but there are pockets within this which have seen a lot of excess. A good part of that excess has been wiped out, but there could be more to go in these segments. So I don't, now consumption has been weak, the environment has been weak, but I don't think sectors which haven't participated in that kind of a huge rally are susceptible to downside risk.
So the so-called narrative stocks that you are saying is not completely corrected. It is corrected, but not completely.
There is some room to go.
So therefore, what is the pocket? You're saying consumers?
Banking, there was no, or financials in general, there was no excess built. Consumption, there was no excess built. Tech, there wasn't any excess built. Now, there could be other reasons, like if US slowdown is there, then they may suffer, but there wasn't any excess built in some of these sectors.
Right.
So consumer discretionary, consumer staples, IT, financials, these are telecom. There are no small caps, but there weren't any excess built in this. Healthcare, there wasn't any excess in our assessment. The excess was built in more, some of these infrastructure, industrial, deep cyclical names that we talked about.
So for you, what are the top bets?
So located across all sectors. If you think of we all given the weight in the benchmark as well, in the opportunity set, we always have financials as the largest. So particularly the largest allocation. So large cap lending institutions, both banks and non-banks, but also capital market intermediaries, which tend to be small caps or small to mid caps. Those are fairly well allocated in the portfolio. Mid cap IT companies, which are very strong at execution, they have for many, many years been very important part of the portfolio. Healthcare. So healthcare, when I am saying it's not just the pharmaceuticals. Within pharmaceuticals also you have more, we tend to be more domestic oriented than US oriented. And then in healthcare you also have hospitals and diagnostics, which is where we continue to find these are across mostly small and mid, but also large cap. And consumer discretionary as well across small and mid caps are few of the pockets where we continue to find. Industrials also selectively continue to find a lot of opportunities.
But what about mid cap IT? You said do you not see some sort of disruption because now global growth slowing down? Will it not have an impact?
No, absolutely. Global growth is to slow down as the markets are suggesting the demand environment would be weaker.
Right.
And it would hit all large, mid, small. Yeah, but the best executing companies would gain market share and still continue to deliver. Like if you see over the last 5 years, we've had post-COVID fears of demand slowdown and then demand very strong, and then post-22 actual demand slowdown in IT demand. But there are mid-cap IT companies which have delivered through all these years double-digit return. Double-digit, not returns, double-digit growth.
Right.
In top line as well as bottom line in cash flows. And they, with ups and downs, they've been volatile. No doubt. During COVID, they got hit very badly, and just last 2 days, they've got hit very badly. But I think through these ups and downs, they've performed extraordinarily well on operating metrics and as well as in the market.
And what do you see, how do you see growth this year? Because I think till this Trump conversation came into the picture, people were, especially after the budget, people were thinking that this, FY25 was perhaps the worst with 5-6% growth. Next year we might get to 10-12% growth. What is your own estimate of where we will be in terms of earnings growth for FY26? And what are the vulnerable pockets there, and where could you see surprises, if at all?
So I think if slowdown is indeed strong in global demand, otherwise, if you look at the large components of Indian earnings or market, so banking or financials at 25%, they aren't impacted by what's going on with tariffs and whatnot. Obviously, if global slowdown is so dramatic that India slowdowns to a considerable extent, which I don't see as a case, then it would impact the growth of the banking sector as well. But I don't think banking sector is much impacted. Consumption isn't much impacted. It's already been impacted. For now, it's one of the deepest slowdown in consumption in ever that I can remember. Now, that can continue, but when something's so beaten up, it has the potential to maybe normalize back to the longer term trend line, or maybe remain sluggish as it is, but it's hard to see how consumption can nosedive from where we are. So,
you mean in terms of growth?
Yeah, consumption growth at the So consumer staple companies, consumer discretionary companies, they've been under pressure. Demand environment has been under pressure for last couple of years. So banking, consumption.
But why do you say that? Why do you say that? So I'll tell you the context, because there are two things. One is that corporate profitability for consumer companies is, I think, at a 10-year high for sure, because last 10 years they've been expanding margins with very little top line growth. Secondly, I had a conversation with your namesake Prashant Jain last week, and he was of the view that this tax saving, which people often, at least in the last 3-4 months, it's been the narrative that this 12 billion tax saving that we get, if you sort of front end for 3 years, people will start spending more, they will leverage more. So there is so much more spending capacity. Therefore, demand constraints will go away. His view was that in, small cap, mid cap, we've seen a 20% correction at the very least. And at the top, small mid caps was about 40% of the market. So out of 5 trillion, 2 trillion of small mid caps, 500 billion wiped out. That is enormous in front of the consumption spending that is getting created by the government. So by that logic, one, profitability is high for many of these companies, most of these in the entire sector. On the other hand, there is constraints in terms of demand growth. So why would you see consumer doing well at all? As might have opportunities.
So I'm not suggesting consumer would do well. I'm saying they've been under pressure for the last 2 years. From here, can it nosedive further from here? It's always possible. You can always paint a doomsday scenario, and one looks smarter when they paint a doomsday scenario than an upbeat scenario. Yeah, so one can paint a doomsday scenario.
You think 500 billion is a doomsday scenario? For the wealth effect, is it
exactly?
No,
I don't think wealth effect is so powerful a factor in India. It's not like US where people have huge, almost, every Joe Schmo has a big investment or good part of their net worth invested in India. If you look at India, it's still some 5% of household assets or something at an aggregate level. I'm not saying it's completely irrelevant, but the impact is highest in Bombay. Yeah, when India is not Bombay. So that's how I would
value-wise, isn't it correct? Because
gold, on the other hand,
I asked
gold,
the same question, Prashant.
Exactly.
I asked the same question to Prashant. So his view was that gold is looked at as a store of value. People don't sell their gold and spend. But when you see money in demat accounts, so we should do a Prashant versus Prashant sometime later. But yeah, please.
Just saying that overall the wealth effect historically, as it pertains to equity markets, I hope for both our benefit that someday India reaches a point where equity market ups and downs would create a wealth effect on people on the main street. Yeah, it's more of a Bombay effect in my assessment. So my limited point was that there isn't any excess built in consumption segment for us to see a sharp drop down or a further decline. It can happen, but the other way around, normalization to the historical trend line. When did you last see consumer companies report such low growth, both on discretionary side as well as staple side, such low top line growth for such a long period of time? Yeah, so I can't think of anything structurally that has changed. So consumer, banking, IT we talked about, healthcare remains always fairly.
So what's your take? So what's your take on healthcare? One is that it is done quite well in the last 1 year. Secondly, Trump is saying that this is a separate category which, he's evaluated, and he's going to come up with an announcement in the near future, not in the distant future. So what's your take?
We're not sure whether he also knows what is in his mind right now. But certainly something would come out, and we'll have to reassess at that point in time. Right now it's very difficult to say. We in our portfolio, as I said, just have always happened to be more, have tended to like companies that have domestic business, predominantly domestic business, because the domestic business has more pricing power. It has more, we are branded generics in India, right? So these are branded products, unlike in US, which is generic, and the price competition is always very intense. But beyond the portfolio, if we were to step back, yes, there could be impact if there is heavy tariff announced, again, for pharma companies or otherwise companies that are predominantly capital investment heavy with lower component of labor skilled labor, semi-skilled labor, that would be a greater risk that why can't this same plant be in the US? Now, in case of healthcare, the lead times are much longer. You have to remember, many plants would take 2 years, 3 years to be set up and then FDA approved and whatnot.
Right.
Yet the longer term impact could still be there, and the markets would react to the longer term impact rather than near term earnings, which may be protected in case of healthcare, unlike other segments of the economy.
Right.
So on the whole, I would say the earnings for India always maintained. See, in India, the sell side and market in general always predicts mid-teens earnings growth.
Yeah.
Regardless, you'd go back last 20 years or any point in time and look,
for this year.
including for this year and the next year, 15%. If the environment is extremely bearish,
12 to 15%.
then 12 to 15%. If it's upbeat, then 15 to 18%. Only rare exceptions like COVID or something would people project, a much lower or a much different growth. So the projections are 15%. I've always tended to believe that base case, low double digits, which is in line with nominal GDP growth, is an appropriate expectation, especially now where if you look at corporate profits as a percentage of GDP, we are no longer at suppressed level where we had reached in 2018, 19, 20 or so. So from a peak of 7.2% in 2007-8, we had reached to a bottom of 1.5 to 1.8 to 2% profits as a percent of GDP. Longer term average is just under 4. And we are at this time just around 4, just over 4. So we are at average levels. Now you can argue the pendulum is to swing further higher, in which case corporate earnings growth can be higher than low double digits. But I think it's more reasonable to assume that we would be at the longer term average level of about 4%, in which case low double digit earnings growth is very good in this kind of, in a moderate inflation environment, you get earnings growth that is in line with nominal GDP. So 4 to 5% GDP deflator and around 6% real GDP growth, which has been the growth for the last 20 years, and reasonable to expect that to continue. And we should have low double digit, 10 to 11% nominal.
Tell me if I had asked you day before yesterday, would you have said 10 to 12%? So why are you saying 10 to 12%? Are you saying 10 to 12% today after such a big global reset where everybody is saying that global growth is going down by?
As we discussed, not much except for the IT sector.
But one big part is commodities, isn't it? So at least from the index perspective also.
So commodities are in India. You get it. That's 3% of the index, and IT is 9 to 10% of the index. So this 13% of the index would see some moderation. And I think IT could be, very minuscule moderation. So if you look at even global financial crisis, Indian IT companies actually grew earnings despite all the projections, disastrous projections. So could the Indian IT companies sector growth can be, instead of in dollar terms, instead of 6-7%, could it be 4 to 5%? Yes. That's a 3% moderation on a 10% base. Even if earnings are moderating by 5%, that's 0.5%. Change. We're not like, I'm not like this.
So it's more towards 10 than towards 12. So that might be.
And these are all pre-tax.
Sure.
In terms of returns expectations from the market.
Fair enough. Okay. By the end of this year, what do you think? Where do you think? What kind of return would we have made? And will we be better than US equities? Because there are a lot of investors in India who are invested in US equities, including mutual funds which invest in US equities.
So the first newsletter that I ever wrote was at the end of COVID year 2020, and the title was Macro Shakro. And the conclusion was that it is futile, or it talks about the futility of predicting futility of predicting market returns going forward based on present day macro environment. Because the market is, far ahead far ahead, looking way beyond horizon and already reflecting. So just like it did in COVID, yeah, bottomed on March 23rd and started, reflecting. So at any point in time you ask me, my response has always consistently been low double-digit return from Indian market, which is in line with nominal GDP growth. And for US market, I would also say mid to high single-digit return in dollar terms, which should be 6% to 7% or call it 5 to 7%, which is also in line with nominal GDP plus dividend yield. And it's been so for, not that you'll get that every year.
Yeah.
Over time it's been true, but it is like if you, that's the equivalent of 50-50 in coin flips.
Right.
If 10 coin flips, you ask me, I have to predict 10 coin flips. I'll predict 5 heads, 5 tails.
Right.
The actual result could be different.
Correct.
A lot of times would be different.
Right.
And same would be the case for the markets, but that is still the best estimate of the next 10 coin flips.
So in a sense, what you are saying about the big picture is that the world remains pretty much intact in terms of how equity markets perform. US equities continue to be on an upward trajectory. After this, India continues to be on, but the overall threshold of returns will come down. That's the big picture.
I think overall threshold, because it's so minor. We are talking about GDP, global GDP growth rate, not, I'd be surprised, not that going from 3-4% to negative,
right,
or something.
Coming
Maybe
down
instead of 3-4%, it will be 2-3% for
right.
a year or two, and then limp back to, not saying permanently it will be 2-3%, it will limp back to again 3-4%. Yeah.
Sure.
So the reaction already we saw in the market yesterday and today. It's possible that this Trump bottom we'll see in the markets globally either today or next week. One negotiation he announces that he's negotiated with XYZ country and the tariffs there are reduced from whatever 30% to 15%. You'll see a huge rally.
Right.
Just like during the deaths continued to pile up, but the market kept rallying. So the negative impact of the tariffs may continue for years, but the markets might recover and rally because the incremental news on this front could be positive.
Right.
This could be the very worst news on tariff that we've received.
Right. So a lovely discussion, Prashant. Thank you so much. It was a pleasure having you at the CDA. Hope you all enjoyed watching this show. Stay tuned to Money Control. Thank you so much.
Thank you.